All right, so Gurmeet is waiting patiently to talk to us about his thoughts. And what actually caught my attention, Gurmeet, good afternoon, was your call recently on Independence Day on the stock called India, the multi-bagger India. You believe over the next decade could make huge amounts of money for investors. You've been investing actively for some time and managing money professionally. What is your trigger of getting super excited even at current levels?
Uh, Thank you, Ajay. Being in the markets, in fact, when I started my career, I was too young to understand the 2003-7 cycle. And, index became three and a half, four times in 2003 to 7. I remember lower circuits when NDA government lost election for 3 days. And then market, registering the biggest bull run, at least I've seen in my career. I think the current cycle is reminds me of that. It may not be as ferocious as becoming three, four times in next 4 years, but I think the cycle looks, and I think we are at the cusp of investment-led capex cycle. There are a lot of similarities. I think the old economy stocks are coming back. There is massive infrastructure spend, which is taking shape through metros, through road, rail, airport infrastructure. There are early signs of capex in lot of private capex picking up. So we wanted to compare and wanted to envisage, what would it be 6-7 years down the line. Sometimes we get too short-sighted by seeing the daily movements. Market has made a new high. So our basic theme is that the market cap of India would probably go up 2.5 times, which means there will be a lot of opportunities for wealth creation. Last 10 years, Ajay, if you see, there have been 20% stocks in Nifty 500 which have become 10 baggers, right? Which is the highest for any country. I think Nasdaq is 13%, China is barely 4%. So India actually, the wealth distribution when economy keeps doing better and market caps keep going up is far higher for India. So we think that probably more wealth will be created in next 7 years of whatever total wealth has been created so far. And then we've jotted down what would it look like, in 2030 in terms of our tax collections, in terms of market cap, in terms of the basic infrastructure we have and the digital stack we have, and that makes us extremely positive on markets.
Point you raised, you're making a point that India is a stock picker and multi-bagger paradise. Over the last 10 years, 20% of the universe itself has become a multi-bagger. So you don't really need to be a very big genius of stock picker. You just need to find reasonably decent stocks and stick to them and ride them on a 10-year basis to multiply your portfolio. Talk to us, Gurmeet. Right now, you're running two schemes, if I'm not wrong. Whatever the universe of stocks you're keeping in your portfolio or advisory, I want to understand what is the kind of earnings growth those companies are throwing up, not on a quarter-to-quarter basis. When you analyze 2 to 3 kind of runway, I want to understand 75-80% of your portfolio showing good earning prospects or lower.
No, it's been a good ride, although it's just 1 year old and it's too little a time to talk about it. We are more than 23% on earnings growth as far as the universe is concerned, which is slightly better than what Nifty reported for last 2 quarters. I think Nifty EBITDA growth for last 2 quarters is almost 19-20%. So we are a shade better. On top line, we again are in double digit. Nifty is probably at about 5-6%. I'm just giving a benchmark. It's not really comparable to Nifty, but just to benchmark and tell what we are up to. And as you rightly said, 70-75% of the portfolio is core, which we basically want to buy and ride for next few years, 5-10 years, more the better. And about 20-25% is satellite, which is dependent on special opportunities or in a deep value play, a demerger or any corporate activity or a sudden drop in business because of non-business reasons. So we play that, but large part of the portfolio is that, and we expect for next at least 2 to 3 years, we should do more than 3-4% than the nominal GDP growth, which will be 12-13%. So I think our earnings should grow around 18% plus, hopefully. And that eventually will reflect in the price. So a lot of time, these boring businesses, if they continue doing well, and I've spoken about them with you so many times, is what create wealth. If the business continues to, generate free cash flows, grow 15-20% quarter after quarter, year after year, and that's when, the big multiplier, which we call P re-rating happens, right? The company gets re-rated because it's so consistent. So the first few years you might find it boring, but when the re-rating happens, you suddenly make up. You probably make more money than you would have made in, let's say, first 3-4 years than you make in the fifth, sixth year when the re-rating happens.
Gurmeet, how are you fighting the challenge of stocks running up and becoming much more pricier than what they were, say, 1 year back? Or in cases where earnings growth are growing in the same proportion, you're still choosing to hold them onto it.
In fact, we are very happy if the stock doesn't move and earnings goes up, and that's what helps you make slightly better returns. We've seen that with ITC for a long period of 3-4 years. Earnings are going up, and the stock refused to perform. The same is happening in some other pockets, including some of the large banks, including HDFC. It happened with Reliance from 2013 to 18. So, a good company going through, if the business performance is good and stock performance is subdued, is actually, we look at it as an opportunity. I'm a little more worried on pockets where earnings are not growing and stock prices have run up too quickly. So there's some froth in the market, especially in the small cap space. Some of the defense names have gone up. These defense orders, they take 10 years, 12 years to execute, and there are different milestone payments. Probably the prices are discounting, the developments over the next 4 or 5 years. Similarly, maybe few pockets in electronic manufacturing services. It's a very low margin business, and people are trying to extrapolate and discount, which is what market is, right? It just tries to extrapolate and discount things quickly. So few pockets in small cap, I think, where the stocks have run up, and people are giving you new stories that 100p multiple is justified. I think those are the things you have to be careful of. In fact, where it has not gone up or it has gone up in line with earnings, there is no risk as such.
All right, Gurmeet, we'll let you go on that one. Thanks so much for your time today, and look forward to catching up with you very soon whenever you are here around in Mumbai. That was Gurmeet of Complete Circle, and talking about